that what I can share with you will get you prepared for the week ahead in a way that can help you make some profitable trades. Let's see. I guess it's about 5 o'clock out there in Singapore. Missing the place, love it. When I was there just in December. Looking forward to a possible return visit in 2026. So I think I want to share my screen and just go through what's up ahead in the calendar and the week upcoming. And you may know this, you may not, but it is just Forex Factory's calendar. And I want to point out a couple of things that I think are going to move the markets and be important. Specifically, we've got some numbers coming up on GDP in China. That may or may not be a big impact. But these ones certainly will be in the Canadian dollar and the US dollar CPI. And this is Tuesday. So on Tuesday, you're at 6:30 a.m. and that is, I wonder if I could set this time zone to local Singapore. Is that possible? See if I can do that. What's that going to be? Seoul is, where's Singapore? Is that, oh, there it is. I'm just staring right at it. There we go. All right. I'm going to put this to Singapore time so that you can, there we go. 8:30 p.m. Singapore time on Tuesday, July 15. That's when the fireworks start. You're going to hear the CPI numbers come out for Canada, and the CPI numbers for the US all come out in that same hour. A little while later into the US session, after midnight, we'll have a few Fed members speak, and that will probably do something in the stock market. But as far as the currency is concerned, I expect that these CPI numbers are going to have an impact. I don't know if they'll have a major impact, but they'll have something. And then 24 hours later, you'll have the core PPI numbers. And this is, both of these numbers are government published indexes. But generally speaking, the market still pays attention to them. So they're kind of important. Yeah, thanks. Thanks about the compliments on the cap. Yeah. All right, so Thursday, and it's gonna be that's same thing on Thursday. So we got something on Tuesday, Wednesday, and Thursday. Core retail sales and unemployment claims in the U.S. And then these will all have impact on the U.S. dollar and by extension on the euro. So there's the possibility, and that's all leading right up to the G20 meetings that begin on Thursday and run through the weekend. Now, I don't expect those meetings to have a big impact, but the market knowing that those leaders are going to meet and that there might be something that influences policy come out of that. The latest information that they would be talking about in policy would be affected by these inflation and retail sales and unemployment claims numbers. So I think that the market really is going to be watching them. And in fact, I kind of feel like, at least in the case of the U.S. market, I'll show you that chart here in a minute, the things have been really quiet. The volatility, the range of trading in the stock market and in the euro, USD, have really dampened. We have seen, let me show you this average true range here, and you'll see it for yourself. Ever since the whole, Trump tariff business, this is all the nervousness associated with that, the weakening of the U.S. dollar. But the weakening of the U.S. dollar has continued since then. strengthening of the euro. But as that has happened, look at this average true range indicator. It is just on a downward slide. It keeps getting lower and lower. What this means, this average true range indicator, is that the size of the trading range each day on average is getting smaller. So here you see some big candles. That's why we ran up like that. And then ever since then, the candles have been getting smaller and smaller until most recently, tiny, tiny, tiny average. A couple of big days, but generally speaking, it's gotten a lot smaller. And that usually happens when the market is ready to reach some state of equilibrium. And a catalyst is needed to take it out of equilibrium. And if you're in equilibrium, prices just sort of hold flat. If you move out of equilibrium, a catalyst has to get you there. So if we think of this as we're in a bit of a I'll use this indicator here, a channel right now. If we already are in some sort of state of equilibrium, then perhaps it looks, like that, right? Come on, go. Visual order. Send it back. There we go. No? Why is that not? Visual order. Green front. Okay, there we go. All right, so if that's what we were in, and we were just sort of holding inside this range, and I'm not saying that's where we are, I'm just, if it were, then you'd have to ask yourself, what is it that could, break it out? Well, I'm suggesting that those 3 days worth of news are the catalyst. If in fact we were to break out of this, those things could do it. And you see we're on the bottom. Could it be that we're poised to sort of go down? Let's look at something else here. What I've got up on the chart is a linear regression study. The euro has had quite a persistent upward trend since just after the beginning of the year, right? And if you draw a regression trend, a regression is just statistically what is the middle line based on all the data. That dashed line is it. And then these lines, these sorts of green and yellow lines, that's one standard deviation, 68.2% of all the data. Most of the data stays inside between those. And then we get out here to 95% for 2 standard deviations with this little bit of data out here. Now, this isn't predictive, okay? This looks nice. It looks like, wow, that's the trend, right? Well, that's just because statistically those lines draw themselves on whatever the data is. If I'd gone back the previous 6 months, you'd see lines that, just fit all the data in. But it is useful because we say, hey, if this is the last 6 months worth of trend, then is it possible that it will continue that way for the next 6 months? And it's highly unlikely because trends just don't last that long, especially on the euro. It could happen. How could we know that somehow the trend is about to break or change or not last? That's a question we can probably anticipate. We can't know for sure, is it going to go up or is it going to change? But we can ask ourselves, well, what would be the indications of it changing? That's why it's useful to look at lines on the chart like this, because we say, well, if it comes below this green line, we're outside of the one standard deviation. We're in between 1 and 2. This is a statistically unusual area. What has happened the past 6 months? The price of the euro has rebounded. So if in fact the news comes out this week on Tuesday, Wednesday, and Thursday and doesn't shock the markets into something new or weird, then what would happen is you'd see the euro maybe come down below the green line and bounce right back up. And every time it has bounced up, hey, that's been a good long signal on the euro USD pair, right? So that could be a nice situation where Monday we dip down, Tuesday we get going, and you're off to the races. So keep an eye out for that. However, there is another possibility that the markets could go the wrong way. Well, wrong if you like going long. If you can anticipate it in Forex, you love it, right? If in fact it were to start going down, then what would happen? What would we see? Well, last time it did that kind of downward move, it got going pretty fast and furious, and there were some great trade opportunities here. And so it might be that there are those sorts of similar trading opportunities here. I don't know. I don't think that those are in the works, because in the first week of August there's the possibility of tariffs, and the tariffs have only made the dollar weaker and the euro stronger. So that, if tariffs come about, the only thing that would really change it, there are two things. One, if somehow the tariffs were just going to go away, I think that the drop in volatility here is that the market's kind of expecting the tariffs to go away. But the second thing, the bigger thing, is the possibility that the U.S. Fed will lower the interest rates, or at least signal that they are going to eventually lower interest rates before the end of the year. Now, they already came out and said in their meeting, yeah, we're not sure, maybe we'll do that. Definitely not by the next time, but maybe by the end of the year. And then the notes came out this week, the minutes, and said, and people read into those minutes and said, well, there were more Fed governors, the committee members, that shifted from, nah, we don't think so, to, yeah, we probably think so. But that's just like, out of 12, maybe 2 or 3 or 4 shifted over that hadn't been there already, So it's not insignificant, but it wasn't enough to really seriously move the needle. So the big question now will be, is there anything in the inflation data that will help push the Fed governors? Because the Fed governors watch the inflation data. They watch the CPI, but they really watch the PPI. So if in fact the CPI came in a way where it was declining, where inflation was going down, then Fed governors would know, hey, we don't really need to keep the interest rates as high as they are. But if inflation were hanging around right where it is, see how in the past several months it's the CPI numbers have crept higher and higher? If in fact those were to continue up at this level or creep even a little higher on the next print, this on Tuesday, that would make the Fed say, no, we don't want to lower interest rates. We need the pressure of interest rates to keep inflation from going runaway. On the PPI, this thing has kind of been declining, okay? So some people have looked at this and thought, hey, we really can't expect the Fed to lower rates because this thing has not been creeping up. The CPI it's a little funky. It gets, maneuvered and jiggered around a little. The PPI less so. And as you can see, the peaks have been getting lower on this thing. And so it's actually signaling that there really isn't, from a producer point of view, this is like wholesale, okay? PPI is kind of like the prices, the wholesale prices, and the CPI is like retail prices. You can think of it that way. And wholesale prices have been getting lower. Now that might be because they're kind of compensating for tariffs. Hard to say if that's what's being baked in there. But what we're seeing here is a little bit of a divergence, We're seeing the CPI grow and the PPI shrink. And you would think that eventually one would come in line with the other. So the PPI print will be pretty important this month because people are going to want to see, is the PPI following along with the CPI? And if in fact there's some sort of evidence that says it is like a high number, a high PPI number would mean, oh, inflation really is coming in. That would mean interest rates are not going to decrease. That would strengthen the dollar and weaken the euro, right? The euro is heading up for one, the tariffs, and two, the possibility that the Fed really is going to lower rates. And so the dollar is weakening in anticipation of that. But of course, the markets have been going through their weakness, or this anticipation, I should say, and the tariff stuff for several months now. So the fact that, they're going to lower rates might not be this big shocker. It might be already priced in, as they say. I kind of think that the bigger danger is the opposite. What if all of a sudden they say, not only are we not going to lower rates, we're not going to lower them at all this year, and we might have to combat inflation by ticking back up 0.25%. And if they were to say a thing like that, then you'd see the euro reverse course and reverse course hard. Now, I don't think that's going to happen, but if anybody believed it were about to happen, you would see it manifest itself this week based on those reports. And what would that look like? Well, what that would look like is that you'd see prices come down here and even eventually cut that line right there. If in fact you were to see, you want to, take a screen capture of this chart. If in fact you were to see prices, come down below this line, then that's the end of this trend as we know it. In fact, even a touch of that line might signal that end of trend. So you want to watch to see over the next few days, does the euro dip down into this 1 to 2 standard deviation zone, and does the market's response to the CPI and the PPI create a bounce back in the euro compared to the dollar? If so, trend still on, baby. Play the euro long. If not, look for shorting opportunities. Now, I'm going to show you a couple of indicators that make me think that shorting opportunity might be on its way. Here is the rate of change indicator. This is just looking at the rate that the euro is going up or down. And you can see this thing is dropping pretty hard, even though the price is not falling fast. It's coming down, but look at how it did in the past. It went from here down to here, right? And this was a monster drop, right? Then we go from right here and that high down to about there, and this is about the same distance that we've moved over the past week or two. And what do we get? We got a move that was like nothing, just a hard little, or this tiny little, hardly even moving on the rate of change. But now we've got this huge move, not quite as big as here, but the price looks really tame, but that rate of change looks really big. And what does that mean? That means it's weakening. The trend is weakening by that indicator. How about this one? I gotta do it this way. This is the stochastic indicator. When the stochastic indicator has, trend line, when you have a divergence, okay, like notice here we've got a peak that goes from this day to this day. See, that goes higher, and the peak of the stochastic goes, this isn't the stochastic, this is the commodity channel index. Yeah. See how it goes higher and higher here. In other words, they're doing what they should be because the price is going higher. But then all of a sudden, price goes even higher, and this thing did not make a peak, right? That is a big old warning sign, what we call a bearish divergence. And it says, hey, short term, watch for this price behavior to change its trend. And of course, that happens. See, if you knew that was coming, these divergences, they're not 100%, but they do give you a warning, hey, it could be coming. In this case, it did follow through and make a divergence, right? So now what if we were to apply that right here? See that? We've got the same kind of thing going on. Well, actually, it's like this. There it is. See how we've got a higher high from this peak and a slightly lower high. Not as big as this, dramatic as that divergence, but it's still there. It's interesting because what this means is, hey, we're slowing down our upward movement, upward trend. So that's the commodity channel index. Here's the stochastic indicator. The stochastic indicator is not showing that kind of a divergence, right, on a longer term basis. So this is like, the monthly stochastic, and you can see from here to here, on a big picture perspective, it was going down. So this, even though it jumped up, it was weakening, and you were, needed to be ready for that. Here we don't have that. So this, stronger, longer term trend is still in play. If in fact I were to change the time frame on this, now this setting, I got to tell you, it's pretty reliable. I've watched that for over the years. I've been surprised how reliable that can be. But that's with a 30 K length and 3 and 3 smoothing. If I change this to its default of 14, 5, and 1, then we get a different look, right? Here we get, it's still not quite coming up. I mean, it's not creating a bearish divergence, certainly not like this one. And this one here didn't really even show up right in front of that. But that weakness, see, this is what you want to look for. See how as soon as you have this one to this one, and when you see weakness, then you watch for the cross below the 80 line. And then you really want to see at the 70 line, what are we doing? Right here on this 70 line, that's where we stepped back in from outside 2 standard deviations to 1. And from there, it went kind of fast. Okay, so what are we doing here? We're inside the 1 standard deviation, and we've crossed below 70 already. So this area here is weaker than this area was back here. Could it be that we're going to cross over and keep going, right? See this thing sort of run down. These things aren't specifically predictive. They are just tracking what has happened in the past. What this tells me is the trend is weakening going into these 3 days of potential catalysts report. We didn't have potential catalysts over the past week. That's why it got quiet. The market is waiting for data that might cause the Fed to change its mind, or that they believe that would change its mind. And so when is that data coming out? This week, this coming week. So that's what you got to watch for. 8:30 p.m. local time Singapore for the next, or for Tuesday, Wednesday, and Thursday, you might see some impact. So if you're the kind of person who likes to trade on 1 hour or 4 hour charts, you might want to pick one of those evenings and, settle down around 7 to 8 o'clock, get your trade in place, and get an anticipation of a big move. Check out what the daily wave runner is saying. Maybe there's going to be a trade opportunity there. So that's some timing to watch for. All right, before I go on from here. Any questions to what I've just said? Hopefully I'm clear enough. That's some really interesting stuff coming up this week. And I think that the biggest moves that will be apparent in the market on Euro USD are going to just ripple over and drive others. No questions? Great. Hopefully that means you're following the information that I got and all good with. Before then we go too far, Sharon has got a question. Raise the hand. Go ahead and type that into the chat. I'm not sure I have the ability to light your microphone. Go ahead and can you type it in? No? Yeah? Oh, typo with that. Raise the hand. All right. Dollar yen. So here's we looked at the euro. If in fact the euro were to change that upward trend, that long, strong upward trend, we would probably see a similar change in the US dollar, Japanese yen. The interesting thing about this is the yen was trending pretty heavily when the euro was not. And now that the euro is trending, the yen is not. Here comes the big question then. Will these changes, whatever they are about to come in the next few weeks, cause the yen to change trend, right? So if we put the regression channel on here, we can see that's kind of the slight upward drift that we got. It's really kind of short term. Probably a more interesting chart or interesting observation is going to be this sort of thing. Well, let's see. I wonder if I could create a curve. Do I have a curved line here? There it is. Okay. Because what I'm seeing here is something that looks a little like this. Yeah, there we go. So if we were to connect all of those tops, this is how it's looking, right? It's a little, I was gonna say it's a little bit of a curved fit. It's a lot of a curved fit because it is fit right to where things are. But that's what you want to do when you're anticipating a catalyst. What we're going to want to see is, will the Euro USD close above this line? So far, it has failed to close above that line on a daily basis. Friday, it got close, right? Are we going to open up the coming session here in a few hours up above there, and will it stay? But come Tuesday night, when these numbers appear, what are they going to do with the U.S. yen? Are they going to push it up forward, or are they going to make it go kind of up and then back down? I would imagine that if we go up and back down, you're going to see the euro dip down and jump up. So those will be correlated. If in fact the euro gets weak, we will see this thing jump up and a potentially new upward trend in the U.S. dollar. That would imply that the interest rate cut is more certain. If in fact we saw this thing start to head up, then it would probably be the case that there's going to be a cut in interest rates. Now, that's a little counterintuitive because the U.S. dollar is, if rates go up, that's good. If rates go down, that's bad for a currency, right? But notice we already saw that trend, mapped in the price of the Euro USD. Everybody is anticipating Euro USD will, or the Fed will cut rates sometime this year. Therefore, the dollar will be less valuable compared to the euro. That's why you got that trend going up. Here, though, shouldn't that be, if that were the same thing holding true for this pair, shouldn't we see this thing continuing lower right through here? And what we saw was no, it's drifting higher. What I find is that the Euro USD is also strangely correlated to the U.S. stock markets. The U.S. stock markets, specifically the tech sector, and this having to do with semiconductors, and other technological components. And today, that means AI, the production of chips and AI chips and the use of AI technology. So the yen is a little bit of a currency proxy for AI and AI technology right now. If in fact U.S. lowers interest rates, then the dollar-yen pair will then the small cap companies and the chip companies who need to borrow money will be able to borrow money cheaper and be able to be more productive. And that means that the U.S. stock market will rise. If that happens, people will move their money into the dollar, out of the yen and into the dollar, and that's what we will see. That's what will drive the upward trend, even if interest rates on the U.S. dollar are about to fall. That's the way I would see it. That's the way I would interpret this. So there's a good curved line for you to sort of watch for the coming week. We close above it, and if we close below the euro, then we could expect both of those trends to continue. All right, everybody. Hopefully that was good information for you. A couple of things to keep an eye on, and a couple of noteworthy news events, all happening 8:30 p.m. Singapore time over the next week. Until next time, everybody take care.